Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. Yes, very busy night in New York trading. If you're curious, just go and take a look at the 1-minute chart of the New York trading session. We had some 1-minute bars that were almost daily ranges, but certainly we had a big back and throw all night as traders ran from one side of the boat and back to the other again. And of course, some of this is headline reading, algorithm trading, models, etc., where the computers just take over. But also it certainly works in favor of some of those big trading houses in terms of setting off stops that it created. The market went down, went up, down, up, down, up, down, up, but the ups became weaker and weaker as the day progressed. This is why I think we could see some upside in Asia, but it will likely be limited. I think the New York Open later today could see some initial buying, but I really do think institutional selling is back, and it's back with weight. That doesn't mean it's going to dominate, because there's still plenty of funds around who just want to buy for the sake of buying, on that kind of fictional fantasy story of a Fed pivot, or that fictional fantasy that markets always go up anyway, so no matter what's happening, just keep buying. What a nonsense that is. So where we're left with the US CPI inflation number is that it barely moved down on the year basis, 0.1%. Remember, it's a survey, so it's the same. Inflationary pressures are the same, moving down from 6.5 to 6.4 in a survey that isn't highly accurate. May as well say it's the same. But let's accept, okay, it moved lower. Lower being the operative word for people to want to buy stocks. Not really. But on the monthly data, it actually re-accelerated. Inflation re-accelerated. It went up from 0.3% on the previous month to 0.5%. Now, a great deal of that is that ongoing pipeline pressures in the services and shelter sectors, but also the first impact, the very early stage impact of what I've been talking about for some time, which is the rekindling of higher global oil prices. Now, that flow through is going to continue. So the next monthly inflation number could be quite firm as well. And also just remember that the fact that the gasoline price movement is having such a profound impact on the inflation number just goes to show how incredibly robust and tight price pressures are in any case, that any increase in the gasoline price at the bowser immediately triggers this resurgence of inflation. This on top of the seemingly strong employment data in the United States means that it's all power to the Federal Reserve to keep raising interest rates. And in fact, it highlights what I've suggested for quite some time now, is that the Federal Reserve actually made a mistake by reducing its rate hikes to 25 points. It should have stayed at 50 points, and then we'd probably have one more 50-point rate hike and probably be done for now, because that would have been a 50, a 50, and a 50. Instead, we're doing 25, 25, 25, which means it's not going to have the same impact on inflation. And at the same time, it's a constant sort of soaring away at US and business confidence, because all consumers are seeing out there in Main Street is that the Fed just keeps hiking interest rates. To them, it doesn't matter if it's 50 points or 25 points or 75 points. The Federal Reserve is still hiking interest rates, which is a warning sign as to their investment behavior. Now, there was this flurry where everyone thought, oh, the Fed's near its terminal rate. First of all, people thought it would be 3%, and then they thought it'd be 3.5%, then they thought it'd be 4%. All along, I said, we're going into the 5.75 to 6.5% zone for the Fed funds rate, and we could go as high as 7.5%. There's been some major economists come out in the United States, only sort of 6 months after myself, and make a big announcement that they think the Fed funds rate could go above 6%. Now, we've been saying that for some time. We've been leading the world on that view, and certainly the Federal Reserve itself is catching up to that view. The Federal Reserve is faced with the prospect of inflation remaining entrenched above 5%, perhaps even above 6%, and that this will, what it says, anchor consumer inflation expectations, which will only contribute to, people are debating it, but I think it already exists, a wages, prices, upward spiral in the United States economy. So the Fed is particularly concerned about stopping that dead in its tracks. The Fed doesn't want to take the edge off that. The Fed wants to stop it dead in its tracks and totally defeat it. And therefore, now that it's at 25-point increments, it's going to be hiking for quite a while. So if you like, the interest rate cycle, the tightening cycle, has been elongated by this error of the Fed, which will cause even more economic psychological damage than if we'd had just 2 or 3 more 50-point hikes. And it means that because you're not having the 50-point hikes, you're not having the same impact on inflation as quickly as you would have otherwise had, which means inflation can get away from you again or stay high for longer, which means the Federal Reserve is now caught in a situation of constantly chasing that inflation tail, which means hold your hats, hold your horses, hang on to your hats, whatever saying you may choose. Inflation's going to stay strong, and the Fed is going to be hiking interest rates for a long time. So I think the Fed will hike another 4 to 6 times at 25 points. We all know they're going to do 2 or 3, but I think it will be 4 or 6 because inflation, if oil prices continue to move higher, inflation is going to reaccelerate more firmly than it's already showing signs of doing. And that is all bets off. The Fed just keeps hiking all the way into our 5.75 to 6.5 zone with risk to 7.5%. Equity markets have not at all priced this scenario. Most markets around the world. What will it do to the US economy? Crunch, crunch, crunch. I mean, I was the first to call a US recession. We got that in 22, and I'm calling another recession in 23. But even if we don't get a recession, what we're going to have is around 0, -1, +1, 0 GDP growth for the United States, or much worse, or a -3 perhaps in the next 12 months. So the outlook for the US economy is dire. A lot of consumers understand this, and people talk about, but the consumer confidence number was up. Yes, it's up in disaster crisis territory. It's just volatility of the data series at catastrophic depression levels. So no, the US consumer is not happy at all. And if the price at the petrol bowser continues to tick higher, you will see there is risk the consumer confidence data could tank yet again. So keep an eye out for that. The outlook for interest rates, as I said, much higher. This will be supportive of the US dollar, but at some point people are going to say around the world, you know what? The United States just is not a good bet at the moment. And in fact, the terminology could become, you know what? The United States is not the safe bet it once was. I'm going to put my money elsewhere. And if enough global investors and also sovereign funds and also central banks around the world start thinking that way, and remember, I was the first economist in the world in 2009 through 2012 when I spoke at APEC to advocate a movement to 3 equal reserve currencies, they being the US dollar, the euro, and the yuan. And that is happening naturally. But a lot of the big funds, sovereign funds, and even central banks are steadily reallocating their assets to reflect a more balanced global economy in terms of powerhouse lead players, if you like. So that process is going to continue. If that process were to accelerate, the US dollar could be in diabolical trouble. For the moment, though, I do think that the fact that Fed funds rate is going to continue to go much higher than anyone else expected will bring some support back into this US dollar. We've seen a very volatile night in the Aussie and the Euro. Aussie, Euro closing pretty heavily though. The equity market I'm particularly concerned about is the Australian equity market, which is certainly under a lot of pressure, really underperforming, and from a price perspective looks to have already made a head and shoulders top and have plenty of downside risk attached to it. The pricing in of a continuing globally slowing economy has not occurred to the Australian equity market, but that could now begin, particularly if the US dollar starts to bounce, the Aussie starts to fall, and overseas investors begin to be concerned about the value of their Australian assets in a weakening Australian dollar environment. Could become a bit of a self-fulfilling downward spiral. So a lot to digest, a lot to think about, but overall, looks very toppish in equities. I like buying the US dollar, but I'm keeping an eye out for any signs of that big background story to the downside that I've just mentioned. Thanks very much. Have a great day. Clifford Bennett, Chief Economist, ACY Securities.